The most important topic of today is, conversely, this one, the Greeks. You probably heard of the Greeks, or at least of some of the Greeks. Now, what are the Greeks? The Greeks are, for us, the first set of real risk measures and instruments that we will use in our risk management job, in our hedging strategies. Now, the Greeks take their name from the fact that most of the different measures we will see are indicated by a Greek letter. So delta, gamma, rho. But not all the Greeks are actually Greek letters, because you know that traders and financial guys are not known for being the best expert of ancient Greek. So at a certain point, they started introducing new letters that are everything but Greek letters. We will play today and in the next few classes the role of the front office. Now, as risk managers, there are different types of activities that you can actually perform because there are different branches of risk management within every financial institution, within every company. If you are a financial institution that actually and actively trades on the market, you have the trading function in which you have people trading. The job of the risk managers working in that frontier of the company is that of the front office. They are at the front of the company. And their job is to manage risks on a daily basis or even on an intra-daily basis. Clearly, there are other parts of the institutions in which risks can be aggregated, in which you have longer time horizons. Think, for example, of a mortgage. If you're a bank and you have a mortgage is not on over a 2 hours, 1 hour time horizon or 1 day. It is, okay? So it's a totally different job. And these other parts of the company are, for example, the middle office and other functions that we will see later on. Today, and also next time, we will play the role of the front office, and the Greeks are actually one of the tools, a set of tools that is used by the front office. Most of the computations we will do today and in the next week, in the next classes, are simple so that they can be performed by hand. You can imagine that nobody is doing these computations by hand. Today, everything is more or less automated, and you don't need to be a fantastic programmer. It's stuff that you can really do with Excel, so nothing particularly advanced. But yet, if you have a large number of data, you cannot perform all the computations we will do together. What we want to do is to understand how they work, and later in the course, I will actually show how they are performed in real life. Okay? In the Greeks, we will not consider all the possible Greeks that are a lot. I'm not saying plus infinity, but every day someone comes out with a new Greek, and now the problem is finding the names, because at a certain point letters are over, and you start calling them charm or fashion and things like that. We will essentially cover the so-called first row, delta, gamma, Vega, Theta, rho. These are the Greeks we will cover together. Let's start with delta. Delta is the simplest, but also one of the most important Greeks. Delta is a Greek that measures how sensitive our portfolio is to small changes in the value or in the price of the underlying asset or assets of the portfolio. Now, we will start by making the assumption that our entire portfolio just depends on one asset, because that simplifies the treatment. But in reality, this is not the truth. So we have a portfolio that may contain different assets, with options on the different assets, with derivatives on the different assets. For the moment, we start from a very nice situation in which the portfolio contains, you see, different products, but they are all related to one asset. In this example, the asset is gold. Okay? Now, the delta measures how sensitive our portfolio is to a small change, and small needs to be obviously defined in relative terms, because a change of 1 cent over something that is worth 1,000 is small. A change of 1 cent over something that is worth 2 cents is big. Okay? So small and big are always in relative terms. But we want to understand how sensitive our portfolio is to small changes in the value or in the price of the underlying asset. So let's consider this example. We have a gold portfolio, okay? Means that all the different products, options, swaps, future, forwards, spot positions are all related to gold. The value of the portfolio today is 115,000 euros, okay? And we know that 1 ounce of gold is worth 1,500 euros. Okay, these are the data we have. Now imagine that on the basis of our model or on the basis of empirical observations, for the moment we don't care, later it will become more important. We know that if there is an increase of 10 cents, 10 euro cents in the price of 1 ounce of gold, then our portfolio decreases, the value of our portfolio decreases by 80 euros. Okay? Why? Because some of those options can be, for example, short, long positions. So what we know is that if there is a very small increase of 10 cents in the value of 1 ounce of gold, I lose from my portfolio 80 euros. So if I want to understand how sensitive my portfolio is due to this small variation, I just take the ratio of minus 80, because it's a decrease in the value of the portfolio, over 0.1. Do that, minus 800, that's the value. That's the delta. Nothing more, nothing less. So the delta is, for this portfolio, minus 800. So the delta essentially tells me that if there is an increase of 1 euro instead of of 10 cents, if there is an increase of 1 euro in the price of gold, in 1 ounce of gold, obviously, that will generate a decrease of 800 for the portfolio. At the same time, if there is a decrease of 1 euro in the price of gold, I will see an increase of 800 in the value of the portfolio. So I take the variation of the portfolio over the variation of the price of the underlying asset, delta P, delta S. Unfortunately, delta P is the standard way in which we identify a variation, which is not the same delta we have used until now. So don't make this confusion. It's just a matter of notation. When we write delta P, it means that it's, for example, PT minus 1. So the value today minus the value yesterday, or the value this year minus the value last year. When we isolate delta like this, it's actually the ratio. And if I assume that the variation in the value of the underlying asset is infinitesimal, so it's very small, the delta is nothing more than the partial derivative of the value of the portfolio with respect to the price of the underlying asset. Why the partial derivative? Because you know better than me that the value of a portfolio is not just a function of the price of the underlying asset. There are other quantities impacting on the value of a portfolio. The volatility on the market, the volatility of the assets, interest rates, and many other things. Okay? Since we assume that this portfolio is a function of several variables, if we want to know the sensitivity with respect to just one of the variables, and here is the price, I take the partial derivative. If I assume to have two assets instead of one in my portfolio, I will have two deltas. I will have the delta with respect to the first asset and the delta with respect to the second asset, and so on. Is there a way, once we know that our portfolio has a delta that can be positive or negative, once we know that our portfolio has a delta, is there a way to intervene on the portfolio to try to delete, to cover for the loss generated by a small variation in the price? Yes, there is a way, and this is called delta hedging. So we use the delta to hedge the possible loss. We assume, for the moment, that we don't have any particular restriction. That is to say, if we have to buy something, sell something, add cash, we can do that. So the financial constraints are not relevant for the moment. Later, you understand that obviously, if you have to add 1,000 euros and you don't have them, it's a problem, okay? And maybe you have to find financing for that amount. But for the moment, we don't care. So we can do whatever we want. So how can I actually reduce the delta exposure? So how can I intervene on my portfolio in a way such that if there is an increase in the price of gold, the portfolio will generate a loss, but that loss is immediately covered. So for me, at the end of the day, there is no loss. Now the answer is rather simple in this situation. What I can do is to eliminate, in this specific example, the delta exposure by buying 800 ounces of gold. If I buy 800 ounces of gold and I add this gold to my portfolio, what happens? If there is an increase of €1 in the price of gold, my old portfolio would lose 800 euros. But now I also have 800 ounces. So if the price increases by 1, this new quantity is worth 800. And this 800 compensates the loss of the portfolio automatically. Now, if there is a small variation in the price of the gold, it automatically compensates the loss generated by the old portfolio. This is what we call delta hedging. Now, write it down. The rule and the heuristic of delta hedging is that in order to delta hedge a portfolio, I always have to add or remove, that is to say, buy or sell, units of the underlying asset. So if I have a portfolio on gold and I want to make the portfolio delta neutral, I will have to buy or sell gold. If I have a portfolio that is depending on a specific assets, I don't know, the shares of Amazon, okay, what I will have to do to buy and sell Amazon shares. If it is on apples, I will have to buy and sell apples. If it is on spaghettis, I will add and buy and sell spaghettis. That's the stuff. I always buy and sell the underlying asset, okay? That's how you delta hedge. If you prefer fricandel and these kind of things, do that. I prefer spaghetti, but you know, this is family imprinting. Okay, now the delta is the first derivative of the portfolio with respect to the price of the underlying asset. And it is a measure of sensitivity of the value of the portfolio with respect to a small change in the price of the underlying asset. If I have more assets, I will have more deltas, delta 1, delta 2, delta 3, depending on the assets. But we know that in reality, it is not guaranteed that if there is a change in the price of an asset, this change is small. The change in the price of an asset can be big. So instead of €1 in the case of our example, we can observe in one day, because of whatever reason, that for the moment we don't investigate, for whatever reason, there is a change of €20 or 100 euros. That is a change in the price that cannot be considered small. Now, the Greek that deals with large changes in the price of the underlying asset is gamma. Gamma is nothing more than the second partial derivative of the value of the portfolio with respect to the price of the underlying asset. Gamma is also known as curvature. Why? Because it measures actually how convex or concave the portfolio value function is with respect to the price of the underlying asset. Now, if you remember the geometrical interpretation of derivatives, when I take the first derivative of a function, what I'm doing, I'm essentially trying to understand what's the direction of the function, increasing, decreasing, and geometrically, I'm just looking for the slope of the tangent line to the point in which I'm computing the derivative, okay, with respect to the function. That information is useful, for sure, but I can be much more sophisticated. I can try to understand if the function in that specific point not only increases or decreases, but, for example, is convex or concave. So what's the curvature of the function? This is what gamma measures. Now, why it is important to use gamma and not only delta? Because most financial products are essentially nonlinear products. What do I mean? Let's define what a linear product is first. A linear product is any financial product whose value is linearly dependent on the value of the underlying asset. Okay, if the value of my portfolio linearly depends, so can be expressed as a line, on the value of the underlying asset, that's a linear product. Graphically speaking, I have my market variable, whatever it is, the value of the product, and I have a line. The line can be increasing, can be decreasing, but I don't care. Here's a line. So a linear product is a product in which there is a linear relationship between the value of the portfolio, the value of the product, and the value of the underlying market variable. For us, will be the value of the underlying asset. A forward contract, a future contract, is a linear product. Is an example of linear product. Let's see with some numbers why this is the case. Now, imagine that we are a bank and there is a corporate client coming to us and proposing a given forward contract, which is the following. We agree to exchange, so to sell 1 million euros 1 year from now, and we will receive $1,400,000. Okay? We know that if we look at the market, again, these numbers are not particularly representative. We have 1 year interest rate for euros is 1.25 and 0.75 for dollars. Okay? So what we want to do is first to understand what's the value of this contract. In a forward, but in a future is the same, there is an exchange at a certain time in the future, but today you already set the price of that exchange. Then, if in the future the exchange rate is such that $1.4 million are much more worthy than 1 million euros or vice versa, there will be a winner and a loser in the transaction. Now, what I have to do in order to understand what's the value of the contract, I have to discount the value of the two amounts. To discount means that I want to know what's the value today of 1 million in 1 year from now. Why? Because in the meantime, I could use that money for other things. So if I want to discount, I take 1 million and I divide by 1 plus the interest rate for the euro. 1 plus the interest rate for the euros accounts for 1.0125. If I do that, I get the value that you see on the slides. So it's 987,000 and blah, blah, blah. For the dollars, I can do the same, but I discount with respect to the interest rate of the dollars. And what I get is $1.3 million and other units. Now, if I want to compare dollars and euros, I cannot do that without taking into consideration the exchange rate, because otherwise that would be the same as comparing oranges with apples. Okay, so I introduce the interest rate, the exchange rate. The exchange rate that I called capital E is the exchange rate of 1 euro in dollars. Why? Because I want to evaluate everything in dollars. Naturally, I can do the opposite and evaluate everything in euros. The values in dollars of my forward contract today is what? Is the present value of $1.4 million in 1 year from now, which is 1.3 and something, minus the value in dollars of 1 million euros 1 year from now. So I take the discounted value in euros and I multiply by the exchange rate. It's not difficult to see that the value of this contract is linearly dependent on the exchange rate. It's a line in which the intercept is $1.3 million and the slope is essentially given by the actual value of the euro, the 1 million euro discounted today. If I have a product of this type, a linear product, and forwards, futures are linear products, I have some advantages from a risk management point of view. First of all, gamma becomes useless. It's not important to gamma hedge a linear product. Why? Because the idea, as I told you, is that I have my connection between P and S, and if I use the delta, what I do is essentially, in this point here, imagine that we are here, this is essentially making the linear approximation. Gamma will tell me how this curve is convex in this case, or if it is concave, how concave it is. But what happens if a product is linear? The product itself is a line. And if the product itself is a line, and I take the tangent line in this point, what do I get? I get line itself. Okay? I get line itself. So delta is all I need to know in order to know everything about the relationship between P and S. And if this is the case, the curvature does not add anything to that information. So I don't even care about gamma. All I have to do is just to delta hedge. And if I delta hedge, I'm safe to small and large movements of the price of the underlying. A very important property of linear products is the so-called hedge and forget. We will see that most of the times when we hedge a portfolio, we will need to do that over time because the market variables change. The price changes, can change sometimes in small amounts, sometimes in large amounts. The volatility changes, the interest rate changes, whatever changes. And since they change over time, all my strategy needs to be adapted over time. So it needs to be a dynamic approach to hedging. In the case of a linear product, on the contrary, I don't have to do that. It is sufficient to hedge my strategy at time zero when I enter in the contract, and it will hold until expiration. So once I have delta hedged at time zero, I can go to bed, I can go to a party, I can drink coffee, I can do whatever I want, and totally not care about the linear product any longer. In our example, the one of the forward, if you want to delta hedge, what you will do, you will buy the underlying, that for us are the euros, because we have to give the euros to the counterparty, and invest that amount, the discounted value of 1 million euro today, at the interest rate for the euros, and in 1 year we will have safely all the money that we need. This is the only thing that you have to do in this type of contract to delta hedge, gamma hedge, and whatever hedge you want, because they are not influenced by other type of variables. But the sad reality is that linear products are just a minority of the products you can actually trade on the market. Most products are non-linear, so there is a non-linear relation between the value of the product and the underlying, the value of the portfolio, and the price of the underlying. In this situation, delta hedging without taking into consideration gamma generates an error that goes under the name of delta hedge error. The delta hedge error is the error I make if I ignore the gamma in a nonlinear product, in a nonlinear portfolio, in a nonlinear investment. If you take any option, even the basic ones like a European call, the relationship between the price of the underlying and the value of the option is nonlinear. We will see in more details that essentially is the CDF of a normal and the density of a normal later on, but you see already the pictures there. The delta hedge error is this error. So have a look at the graph there. No? So this is the relationship between the stock price on the x-axis and the value of a call. Okay, I'm not specifying what type of call, but it's not relevant for me. Imagine that today the value of the underlying asset is S. So I am exactly in the point SC. If I take the delta here, I'm essentially computing the slope of this tangent line to the point. Okay? Now, if you look at that, you understand that if my price moves from S to S plus epsilon, or S minus epsilon, something very small, I will stay here on the straight line, but the straight line is very close to the actual curve. So essentially, there is no big error that I'm committing in taking the linear approximation to the curve using my straight line, if the price variation is small. But what happens if, on the contrary, the price variation is not small? That is to say, from S, I move to S prime or S1. If I do that, and I still believe in just my delta hedging, I will think that the actual value of my portfolio is here on the straight line. That is to say, C prime, C1. But in reality, because of the convexity of the true relationship between the stock and the call, this is the true value. It's C2. And this is what we call the delta hedge error. That is the error that we make when we are ignoring the non-linearities in our portfolio. Now, that quantity there can be relatively small, a few cents, say. Well, if you have a large quantity of things that are worth a few cents, then a few cents become a large amount. Okay? So, and it's actually a rather serious error to ignore the convexity or the concavity of the relationship between a portfolio and the underlying assets. Now, luckily for us, as we can delta hedge, we can also gamma hedge. That is to say, we can try to play with gamma in order to make our portfolio somehow immune to large changes in the price of the underlying asset. The big difference, and this is again, write it down, fundamental between delta and gamma, is that, as I told you before, in order to delta hedge, I have to buy and sell units of the underlying asset. But in order to gamma hedge, I cannot do that. If I buy and sell units of the underlying assets, I'm not able to gamma hedge. Why? Because gamma is related to non-linearity. And adding and removing the underlying asset is just playing with linearity. So in order to be able to remove the gamma, we have to add or remove units of something that is non-linear in the underlying asset. And that something is typically an option. Okay? If I want to gamma hedge, I have to add and remove a certain amount of an option on the underlying asset. If I add, it means that I enter, I buy an option. If I remove, I write an option. Okay, that is what I will do. In order to quantify the amount of that option that I need, the computation is very simple. But please recall that if in a problem you are asked to gamma hedge and you are not given any information about a possible traded option that can account for the nonlinearity, the answer is I cannot gamma hedge. As simple as that. So imagine that we have, in this specific situation, the traded option. Okay? And I know that this traded option that we will call T has a gamma equal to gamma T, and also a delta. So the traded option is an asset, and it will have its own delta and its own gamma. Now, what we want to solve is the problem of finding the optimal quantity of this option that I have to add to my portfolio. And from now on, when I say add, I mean adding in mathematical sense. If I add a positive quantity, it's actually plus. If I add a negative quantity, I'm removing, so I'm taking the difference. So I want to add these units. Now what I have to solve is a very simple equation. Is WT, the amount of option that I want to add, times the gamma of the option plus the gamma of the portfolio, and I want this quantity to be equal to 0. I want to essentially make the gamma of the portfolio 0 after adding or removing my option. Now, using extremely complicated mathematics discovered yesterday, this quantity is minus gamma over gamma t, okay? So you just set this equation to 0 and you solve. If you do that, you see that the formula is extremely simple. Minus gamma over gamma t. This is the quantity that we have to add or remove from our portfolio. Very important is the following. As I was telling you a minute ago, the option that we are adding to our portfolio has its own gamma that we use to eliminate the gamma of the portfolio, but also its own delta, very likely. It would be quite difficult to have something with a delta equal to 0. So that's very important to notice that if you add something that has a delta different from 0 to a portfolio, you are changing the delta of the portfolio. So if you have a portfolio that is delta neutral because you made it delta neutral and you add an option in order to make it gamma neutral, there are very good chances that the new portfolio is not delta neutral. So you will have to make it delta neutral again. Okay? So in principle, if you want to be pedantic, I make the portfolio delta neutral, I make the portfolio gamma neutral, it is no longer delta neutral, I make it again delta neutral. In reality, you can make it delta neutral at the end. After gamma neutrality, after Vega neutrality, all the other things, at the end, you correct for the delta. Okay? We will see that in exercises. So let's consider the first exercise. We have a delta neutral portfolio, so for the moment, we don't care about the delta. We will see many exercises of this kind of thing, so all the possible combinations. We have a delta neutral portfolio with a gamma of 2000, okay? Then there is a given option on the underlying asset that I can use to play with the gamma, and this option has a delta of 0.7 and a gamma of 2. Using our extremely complicated formula, we have to take minus gamma over gamma t, so it's minus 2000 over 2, minus 1000. It's a negative quantity. Since it is a negative quantity, it means that I have to add a negative quantity to my portfolio, and this quantity relates to an option. It means that I have to write a position of minus 1000 in the option. Okay? But now, as I was telling you before, the delta of the portfolio has changed. Why? It used to be 0 because the portfolio was delta neutral, but now it is equal to 0 minus 1000, which is the position in the option, times the delta of the option, 0.7. So it is equal to minus 700. What should I do to have a portfolio that is gamma neutral and delta neutral? At this point, I have to intervene on the delta. In order to make my delta 0, I have to add 700 units of what? Of the underlying asset. Okay? I have a portfolio that is delta neutral. I have to make it gamma neutral. I play with an option. I add the option, making my computation, I understand that I have to write in the option a position equal to 1000 in absolute terms. Doing that satisfies the requirement of gamma hedging, but modifies the delta part. So I have to intervene again on the delta by delta hedging. Since I have a delta of minus 700, I have to compensate. So I will add 700. 700 of what? 700 units of the underlying asset. Okay? Option for gamma, underlying asset for delta. The price is not the only, unfortunately for us, variable affecting the value of a portfolio. We have other things. A quite famous one is volatility. If you think of a European call, a European put, an American call, an American put, you know that volatility is one of the variables that you need in order to compute the value. And what happens if the value of volatility changes? Now, here, for the moment, we speak of volatility in a very general sense. It can be approximated with standard deviation, but not necessarily. But we are not specifying what type of volatility. It can be the volatility of the asset, it can be the volatility of the portfolio, it can be the volatility of the market, volatility. Okay? Now, the Vega, which is the third Greek, the first Greek without a Greek name, Vega, the Vega is nothing more than the sensitivity of the portfolio with respect to volatility. So the Greeks are just sensitivities of the portfolio with respect to something. Delta, small changes in the price. Gamma, large changes in the price. Vega, volatility. So it's the partial derivative of the value of the portfolio with respect to volatility. So the higher the Vega, and that obviously means in absolute terms, the more sensitive my portfolio is to changes in volatility. As for delta neutrality and gamma neutrality, I can have Vega neutrality. So I can try to make my portfolio Vega neutral. And please, I know it may appear boring, but this is actually what they do in the front office. A lot of times, for many positions, all day, every day. Now, if I want to make my portfolio Vega neutral, it's exactly the same technique as before, and you end up with a very similar formula. Instead of minus gamma over gamma t, would be minus Vega over Vega t, where Vega is the Vega of the option, again, that I'm adding to the portfolio. So also to deal with Vega, I need options, because I need a product that is a function of volatility. If I have a portfolio that is delta neutral, there is no guarantee that it is gamma neutral, apart from the case of linear products. And there is no guarantee at all that it is Vega neutral. And if I have a portfolio that I made delta neutral and gamma neutral, it can still be, very likely, Vega non-neutral. So I have to make the portfolio Vega neutral as well. You can imagine that what we have to do in order to make a portfolio jointly Vega neutral and gamma neutral is to add options. But the options that I add cannot be the same. Why? Because I simply have to solve a linear system, and I need at least two different traded options on the same underline in order to make my portfolio both gamma and Vega neutral. So let's consider another very simple example. Now imagine that I have a portfolio which is delta neutral. So I made it delta neutral at the moment. But I know that the gamma and the Vega are not zero. The gamma is minus 5,000 and the Vega is minus 800. Luckily, I have two options that I can use to try to make the portfolio both Vega and gamma neutral. Now, how can I do that? Essentially, I will have to add a certain amount W1 of the first option and a certain amount W2 of the second option. Now, in order to find these quantities, I can solve a linear system. This linear system will be 0.5 W1 plus 0.8 W2 equal to 5,000, or if you want, minus 5,000 equal to 0. And for what concerns the second line, it will be 2 W1 plus 1.2 W2 equal to 8,000. Now, what I have to do is to solve this system. So choose one of the two. What can we do? We can choose, for example, W1 here. So W1 from here, it is equal to 8,000 minus 1.2 W2 divided by 2. So it is equal to 4,000 minus 0.6 W2. And now what I can do, I can, for example, substitute here. So I can substitute this quantity here, and this line becomes what? The 0.5 multiplied 4,000 minus 0.6 W2 plus 0.8 W2 equal to 5,000. I keep on going, so this is equal to 2,000 minus 0.5, 0.6 W2 plus 0.8 W2 equal to 5,000. Okay? I keep on going, making my computations. And since I'm extremely lazy and already did my computations before, I can already tell you that W2 is equal to 6,000 and W1 is equal to 400. Now, these quantities are positive. What does it mean? It means that I have to buy 6,000 units of the second option and 400 units of the first option. Okay? Am I done? No, because by doing that, I have the guarantee that my portfolio is now gamma and Vega neutral. But since I have added new positions with a delta that is different from 0, I have to make my portfolio delta neutral again. And again, how can I do that? It will be 400 times the value of the delta, 0.6, plus 6,000 times 0.5. And this quantity here is equal to 3,240. This quantity, it is positive, so I have a new positive delta for my portfolio once I have added the two options. So in order to make my portfolio delta neutral again, I have to make this quantity equal to 0. It means that I have to remove, that is to say, I have to sell 3,240 units of the underlying asset. Okay? If you are given a problem in which a portfolio needs to be either Vega or gamma neutral and you have an option, you can solve it. If you are asked to make a portfolio both Vega and gamma neutral and you have just one option, you cannot. Okay? You always need at least two options. If you have more, better. You can also find the strategy that is, for example, less expensive and blah, blah, blah. But if you want to make something both gamma and Vega, you need both. After gamma, delta, and Vega, we have the other Greeks. In reality, we will not consider those Greeks. Or, to be more exact, we will not spend a lot of time on the Greek, which is nonetheless very important, but not in risk management, called theta. Theta is the sensitivity of my portfolio with respect to time. In risk management, for very different reasons, from the fact that I may have a fixed time horizon, so it will not change, or the fact that in any case, time passes and I cannot hedge the passing of time, or if you can tell me and you will have 10 in this exam, guaranteed, so you can stop coming and you will have a 10 at the end if you can stop time, makes no sense of speaking about hedging with theta. In reality, it is very important, and it is very important from a practical point of view, because you know that if your delta neutral portfolio has a very large theta, then typically it has a large negative gamma, and so on. So they are all heuristics and rules of thumb that can be used. But for us as risk managers, nothing particularly interesting, not at least at this level of sophistication. Another very important Greek that is so important that we ignore it today because we will just give a full class on that is rho. Rho is the sensitivity of our portfolio to interest rates. In reality, we will see that most of the times when we try to play with interest rates and we try to hedge positions involving interest rates, we don't play directly with rho, but with a function of rho that is called duration. But nevertheless, rho is there, and I will show you how to recognize it. So for the moment, we just ignore this Greek. It will be back next week. So delta, gamma, Vega, theta, rho are the so-called first row of the Greeks. There are many, extremely boring to recall all the Greeks, but you can already see here in the list that I can start taking all the derivatives I want. I can take the third derivative, I can take joint derivatives, I can take the derivative of a derivative, I can take the partial derivative of a derivative, I can do whatever I want. And at a certain point, I have to introduce names that essentially are pure fantasy, like Vamma, Vomma, Charm, Vera, Color, Ultima, Zomma, and so on. But we ignore them. They are actually important, but they are actually important if you want, for example, to make risk management or to take financial decisions at a higher level. So for us, they are out of the game. But it's important to know that the first row is just the tip of the iceberg of this stuff. Now, as I told you before, we have a portfolio, and we know that this portfolio is a function of different variables: the price, the volatility, the interest rates, the exchange rate, if there is the exchange rate, time, a lot of things. If you remember from your basic courses in mathematics or even high school, what I can do, I can try to approximate the change in the value of the portfolio by looking at the impact, at the effect of the different variables that essentially influence the portfolio. So I can use a Taylor series. By taking the Taylor series, what I see essentially that all the Greeks pop up. Now, delta, Vega, theta, gamma. If I take the second derivative there, I will have gamma, but I also have all the other Greeks, and I can be as precise as I want, obviously adding terms. Now, in the front office, most of the time, you don't have the time nor the will to use all those Greeks. So it's quite common to make approximations on the basis of assumptions that in good market conditions are not so bad. They become not at all reliable in bad market conditions, so for example during a crisis, but in good market conditions they are still manageable. So for example, let's assume that we can simplify all this series of derivatives in the following way. We have a delta neutral portfolio, so since the portfolio is delta neutral, the delta is 0, so it disappears from my approximation. And we are not interested in the higher order because we want just to have a very quick evaluation. We assume that over our fixed time horizon, the volatility can be safely taken to be constant. And if the volatility is constant, essentially also Vega is out of the game. We don't care about Vega. So I can rewrite everything in this form. I can take that the value of my portfolio changes as a function of the change of time and the change in the square of the prices, so large deviations of the prices, because delta is 0. So the small deviations are already taken care of. But again, if I take an infinitesimal time interval, or even more, I say for me time is not relevant, as I was telling you before, I can also delete this term. So I end up with a formula which is nothing more than 1 over 2 gamma, the square variation of the prices. So very simple. Imagine that I have a gamma and delta neutral portfolio of European option on an asset, and this gamma is minus 5,000. Suppose that in an infinitesimal time interval tending to 0, there is a change of 3 in the price of the asset. I want to have a measure of the change in the portfolio. And the question is, what happens if there is a plus 3 increase in the change, but also, the second question, if there is a minus 3 change in the price? Now, the answer here is very simple. What I have to do is the following. I can come back to the previous slide, okay? And I see my formula, this one. Now, since I'm taking delta t tending to 0, it means that the theta terms disappears. What remains is just this. Delta p is equal to 1 over 2 gamma delta s squared. Let's write like this, it's easier. Okay, if I do that, and you have my data here, what do I have? I have 1 over 2 times 5,000, or minus 5,000, yes, yeah, minus 5,000. So minus 5,000. And then I have the change in the price squared. So I have 3 squared. So what is that? This is 5,000. This is 9. So minus 45,000 divided by 2. It is minus 22,500. So the most important measure that we use in the management of interest rates risk, it's called duration. It's the duration of a portfolio involving interest rates, the duration of a coupon bond, the duration of a zero coupon bond. This is the fundamental measure. And it represents the sensitivity of our portfolio to changes in the yield. Now, the duration is defined in this way. It's 1 over S, where S is the market price of the portfolio, times the variation, delta S, of the price over the variation, delta Y, of the yield. If I assume the variation of the yield to be very, very small, so to be infinitesimal, what do I have? I have that the duration is equal to minus 1 over S ds dy. Now, in economic terms, you can, if you studied economics or you're a little bit familiar with economics, you can recognize in the duration some sort of elasticity. It's an elasticity measure. But what is important to us is to recognize that actually duration is that function I was speaking about last time that involves the rho. And where is rho? Here. You see that duration is minus 1 over s, the sensitivity of the asset we are considering with respect to the yield. And the yield is the interest rate. Okay? So ds dy is nothing more than rho. But when we play with interest rates, we tend not to use rho alone, but as one of the components of duration. Why? Because rho would be an interesting sensitivity of the price of the portfolio, or the value of the portfolio or of the asset with respect to interest rates. True, but if it is used within the duration definition, it gathers a better insight in terms of interpretation of the different quantities. That's the simple reason. Now, imagine that I have a bond that generates cash flows. That is to say, a bond that pays coupons C1, Cn at different time maturities, T1, Tn. Okay? I know that the yield y can be computed by taking that implicit rate that allows me to discount all the cash flows and make them equal to the market price of the bond. And we have this formula, which is nothing more than the condensed mathematical writing of all the discounting of the different coupons. You remember we had the example in which we had 2.5 discounted plus 3.5 discounted until the last payment that was 102.5. This is exactly the case. So C1 up to Cn minus 1 will be 2.5, and then the last one will be 102.5, just like that. And we discount by the corresponding maturity when we apply the yield. Now, the duration, if we want to compute the duration as minus 1 over s ds dy, is just a matter of computing derivatives. So if you are familiar with derivatives, it's a nice exercise and a trivial exercise to do that. Otherwise, trust me that if you perform that by taking the derivative with respect to y, this t comes down. It simplifies with the minus of minus 1 over s. S is here, and this is what you get. This is your expression if you collect all the terms and you use the additivity in the derivatives. This is the formula for duration. Now, this formula is very important because it can be interpreted in a very relevant way. If you look at this formula, you agree with me that these discounted cash flows, when summed together, they sum to S. Okay? So if I take each one of them over S, it's just a quantity that will lie between 0 and 1. I can take it as a weight. And I can use this weight to weight what? The maturities, the T's. So duration can be seen as a weighted average of the maturities of the times at which I receive money from my investment. Or if I'm writing the investment, the times at which I will pay money. Because obviously, if I buy a bond, I receive money. But if I'm a company that issues a bond, I'm paying money. Okay? So the duration is the weighted average of the maturities, where the weights are nothing more than the discounted payments over the market price of the investment of the portfolio, whatever you want. So in a sense, and that's why we use rho within duration and not alone, duration answers a very important question if you are an investor. And it's the question, how long I have on average to wait in order to see money, in order to see a cash flow coming from that investment. Or how long I have to wait, if I'm the issuer, before I pay over the investment. Very important, from this formula, we immediately derive a fundamental difference between a zero coupon bond and a coupon bond. So what's the difference between a zero coupon bond and a coupon bond? It's trivially the fact that the coupon bond pays a coupon. Okay? And if it pays the coupon within the time framework. So if today is 0 and our investment is over 1 year, in a zero coupon bond, I will get my interest and capital in 1 year. If it is a coupon bond, I will get also some coupon in between, every month, every 2 months, every 3 months, I don't know. So you can imagine that what would be the duration of a coupon bond? It will be the weighted average of all the cash flows. And cash flows happen within 1 year. What is the duration of a zero coupon bond, conversely? It is the weighted average of all the cash flows, but all the cash flows are just generated at maturity. There is nothing in between. So for a zero coupon bond, duration is equal to the maturity of the zero coupon bond. If I invest over 1 year, I will get my money in 1 year from now. And if I issue a bond, which is a zero coupon bond, I will pay in 1 year from now. Okay? So that's very important. In a zero coupon bond, duration is exactly the duration, so the time length of the investment. In a coupon bond, duration is by definition strictly smaller than the maturity of the investment. It can be smaller but still close to maturity if the coupons are small, and then obviously the weight of each coupon on the total is irrelevant, and the last big payment will prevail. But if there are very large coupons, duration can be sensibly smaller than the time horizon of the investment. Okay? So that's very important for different reasons. Because if you want to make an investment in a bond and you open your Finanzielle Dagblad or whatever you want, what do you have? You read there and you know immediately, on average, you can easily compute, okay, what is the time that you have to wait in order to see your money? Obviously, this time is weighted by the coupons because money has a cost, and you want to know actually how these times are weighted by the cost of money. That's why you use the coupons. But you also know immediately that if you invest in a zero coupon bond, duration is the maturity of the zero coupon bond. You don't have to waste your time in doing these computations. And this quick information, it's something very sensible on the market. And also during the exam, because it's totally stupid to waste your 10 minutes computing the duration of something that you know is equal to maturity. Okay, so you know it's a zero coupon bond. What's the maturity? 3 years, because it's a 3-year zero coupon bond. What's duration? Yes, 3. Okay? Very simple. So let's consider this exercise. So we have a 3-year coupon bond, so it pays a coupon with a face value of 100 euros. The continuous compounding yield is 12% per annum, and there is a 5% coupon that is paid every 6 months. So every 6 months I get 5 euros. What's the duration of this investment? Now, already before starting your computations, from this very simple exercise, you know that this is a 3-year coupon bond. There are intermediate payments, so duration cannot be 3. It will be smaller than 3. Okay? That's the first thing. Is it 2? Is it 2.5? Is it 2.99? That we don't know. We have to compute it. But for sure, it is not 3. Why? Because there are intermediate payments. Now, what we want to do is to compute duration. Now, to do that, we have to apply the formulas that we have seen before. So this is the formula. Now, in this formula, we need the coupons, and we have that information. We need the yield, and we have that information. We need the maturities. We know every 6 months I have a payment. But we also need S, and S is the market value of the coupon. So the market value of the coupon for us is something that is not given by the text of the problem, so it needs to be computed. Now, look at that formula. So that formula tells me that I have to take the sum for I from 1 to n of what? Of the coupons, CI discounted at the yield rate times TI, the corresponding maturity. Now, for us, what does it mean? It means the following. Let's go back here. So we have a 3 years coupon bond, and we get €5 every 6 months until the very last moment in which we also get our capital back, the face value back. So 100 euros. So what do? We simply have to apply this formula. So the first coupon, C1, is what? It's what we get 6 months from now. So it's 5. We just get 5. So 5 times what? The exponential of minus what? The yield, which is there, 0.12, times the time horizon, 6 months. As I told you, the convention is to use fraction of the year. So 6 months is 0.5. So times 0.5 plus, again, 5 in 1 year from now. So it's minus 0.12 times 1 plus 5 e to the minus 0.12 times 1.5 plus, I go on, I reach e to the minus 0.12 times 2.5. Obviously, here I will have also the other, I can write it there. I mean, it's not a big advantage. I'm lazy, but not at this point. 2.5 plus, and that's very important, at the last moment, 3 years from now, I will get 5, but also 100. Okay, so the last one will be 105 e to the minus 0.12 times 3. Okay? If I solve this, I already did for you, the result is 94,213. But it's a nice exercise to check if my computations are correct. Most of the time I do my computations on the train, and it's not the best situation, so always double check my computations. But it makes sense. That's the price. So imagine that I solve this trick for the exam, and I get that the result is 102. Can it be? No, because I will get a price which is higher than the face value. Okay, so the price that I will get if I have positive interest needs to be lower. Okay, in negative interest rates actually it could be, but never happens for a bond, at least for the moment. So this is the price, 94. Now what I want to compute is duration. Again, check again the formula. The formula is this one. So if I want to compute duration, what do I have to do? I will have to apply the formula. I will not copy the formula, so it's just there. But what I have to do is to take the weighted average of the maturities. Now, what's the first maturity? The first maturity is 0.5, 6 months, times what? The corresponding weight. And the corresponding weight is given by the discounted 6 months coupon over the price of the market price of the bond. So the first is this guy here. So it's 5e to the minus 0.12 times 0.5 divided by 94,213 plus 1, the second maturity, that multiplies what? Here, 94,213 remains the same, and at the numerator, I will now have these. So it's 5e to the minus 0.12 times 1. And I will do that for all the maturities until I reach 3, the last maturity, that multiplies 94.213, and at the numerator, this guy here, 105 e to the minus 0.12 times 3. Okay? If I perform this computation here, the duration I get is 2.65. And you see that 2.65 is more than 3. That will be the duration of a 3-year zero coupon bond. So this investment, if I compute the duration, tells me that considering the coupons and considering the value of money as represented, for example, by the interest rate and blah, 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 on average, I have to wait 2.65 years. In reality, I will see the first payment after 6 months. True, but this is a weighted average of the waiting times of the different maturities for the different coupons. And since the last payment is the biggest one, the average is pushed towards or attracted by the last payment. If you increase, for example, the coupon from 5 to say 10, it will be a totally incredible investment that you will never find. But if you do that as an exercise, if you increase the coupon to 10, you will see that duration will slightly decrease, and so on. Okay? Clear? It's just boring, but not particularly complicated. So let's continue with the same framework, okay? And let's consider a second exercise. So we are still there. This is the duration that we have computed and blah, blah, blah. And now we ask ourselves, what happens if there is an increase in the yield of 10 BPS, basis points? Basis points are a common way of playing with interest rates. Why? Because typically the movements we see in interest rates are very, very small. And instead of saying there is a change of 0.1%, you say there is a change of 10 basis points. But it's just a matter of convention of the unit that you use. The spread over bonds, the credit spreads that you have in CDS, so all things that we will see are typically described in terms of basis points. Okay, 10 basis points, 50 basis points, 150 basis points, and so on. So let's assume that there is an increase of 10 basis points that corresponds to an increase of 0.1%. So this means that my yield from Y will become a new Y star, which is 1 plus Y plus 0.001, okay? Or the variation in Y is just 0.001. Is there a way of quickly computing how the value of the bond changes? you can use duration. You can use duration as essentially quite nice in this setting. Why? So the formula of duration tells me that duration is equal to 1 over s, with a minus sign in front, ds dy. Okay? So I can always rearrange the terms so that the variation in S, the variation in the price of the bond, or the variation in the portfolio, if this is a portfolio, and then we would say delta P instead of delta S, is equal to minus D, the value of the asset S, times the variation in the yield, delta Y. So if I do that, I already have all these quantities because I know that the duration is 2.653 minus times the value of my bond times the variation. If I do that, I know that I can expect a change in the value of the bond of minus 0.25. That means that the new market value of the bond would be the old one minus 0.25. So the new value would be 93.96. Is this value correct? There is a simple way to double check. That is to say, to recompute these, what we did before, so to recompute the present value, but instead of using 0.12, now we use 0.121, the small change that we are assuming for the yield. If you do that, you exactly guess. That's the same result. So you can think of rho and hence of duration as a sort of delta for interest rate related products. Why? Because since we know that the price of our asset depends on interest rates, and we take the derivative with respect to the interest rates, what we are doing? We are just building a linear approximation in the interest rate, which is exactly what we were doing last time with delta. In delta, we were taking the linear approximation by playing with the prices. This is another framework, but it's exactly the same idea. So when you use the so-called duration approximation, that is what we are doing here, we are trying to give a linear approximation to the change in the portfolio just by looking at the first order derivative with respect to the interest rate. Now, as for prices, when we were discussing about the problem induced by convexity and concavity, that is to say, to the fact that if we delta hedge, but our product is non-linear, there is a good chance that for large changes in the prices, there is the delta hedge error. We have the same problem here. We can have two bonds that have the same duration in a vicinity of a point, say at the starting point at time 0, but then they have a different convexity. So if we use the duration approximation, we treat them as if they were the same, while they have different behaviors. So in order to deal with the convexity with respect to interest rates, we can introduce a measure that plays the role of gamma. This measure in interest rates is called simply convexity. So convexity is a quantity that, as duration, is not directly the derivative, but it's a quantity that includes the derivative. In the case of convexity, the second derivative. If you do that, convexity is defined as 1 over s. Notice that here there is not the minus sign. It's 1 over s, the secondary partial derivative with respect to the interest rates, with respect to the yield. Again, if you solve the derivative, this is the formula that you get. Okay? In this situation, convexity is no longer a weighted average, but it's still linked if you want, to the second moment, but the interpretation is a little bit more subtle, so we just skip it. So it's a measure of the dispersion in your model with respect to interest rates. As we did with the other Greeks, for example, with the delta approximation, the delta gamma approximation, the delta gamma Vega approximation, we can do the same with interest rates related products. So we can see how the change of the value of the asset is related to duration and convexity. And if you want, we can say that the percentage change in the value of the asset is essentially this very simple, straight formula that includes duration and convexity. Now, is it useful to use convexity? Yes, no, it depends. If the change in the yield is very small, as with delta, the linear approximation works. So the duration approximation is more than sufficient. In our example before, we had a yield of 12% and a change of 10 basis points. But if the change in the yield is bigger, as if the change in the prices were bigger when we were using gamma, then we have to introduce convexity. And we can see that with a simple example. So consider the same bond with the same data. If, and it's an exercise that I suggest, you compute convexity, the convexity that you will get for that bond is 7.57. Okay? That's what you get by applying the formula very simply and computing the quantities. Now, instead of a change of 10 basis points, so 0.1%, we think of a change of 2%. The change of 2% in interest rates is something extremely big. Okay, it's something that is not very common to be observed on the market. It's quite extreme. Okay, so we agree that 2% is not just 10 basis points. It is not a small variation, it's a large variation in the interest rates. So our yield would move from 12 to 14%. Now let's see what happens if we use the duration approximation or we also introduce convexity. If we use the duration approximation, what we have to do is just to apply the duration formula. So the change in my market value would be the old one minus the old one times the duration times the change 2%. The difference would be minus 4.99 in the bond price. If I introduce convexity, I get a better approximation. And I discover that the change is not minus 4.99, but it's minus 4.85. Now, you may think, who cares? Minus 4.99, minus 0.85. They are close enough. Yeah. The point is that if you then recompute everything, so instead of using the yield of 12, you compute the yield of 14, you find that the actual value is this. And you agree with me that this quantity here that you get with convexity is definitely closer than the one that you got with duration only. And if that quantity is maybe multiplied by a few millions, well, it's an important difference. Okay? It's definitely important for your portfolio. Now, what you can do is to relatively easily, generalize what we have done so far. Typically, as I was telling you at the very beginning of the class, we represent interest rates in terms of a yield curve because we may have the different maturities and we may have the different zero rates. Now, a quite common assumption that is made if you're a bank, we will see later on that banks are, for example, assumed to perform a sort of exercise that is called stress testing. That is to say, they have to make all computations of the different risk measures we will see together, and they have to stress those risk measures by making assumptions like what happens if on the market the interest rate goes up by 1% or it goes down by 3%. What happens if there is a liquidity problem and nobody is giving me money? What happens if there is a crisis on the market? And they have to make simulations to understand what the possible scenarios are and to try to build strategies in order to cover those scenarios. One of the stress tests that is commonly performed is to assume shocks on interest rates. Now, there are many types of shocks that can be assumed. The simplest one is just to assume that there is a shift in the yield curve. So the yield curve was this one, the bold line, and now it's the dashed one. So it is moved up by some quantity or moved down, but it's a parallel shift. The entire curve is shifted. In reality, we can have more complicated situations because I can say, okay, this is my curve, and instead of this, I now consider this. So there is only a shift, for example, for one of the maturities, not all the maturities. But this is mathematically more complicated, so we ignore it there. We just consider parallel shifts. Now, imagine now that instead of just one asset, we have a portfolio, okay? And the value of the portfolio is P. The portfolio is made of assets that have different maturities. I will have, for example, a zero coupon bond over 6 months, a coupon bond over 3 years, a zero coupon bond over 3 years, and so on. So I have a portfolio that is made of different assets. These assets will have their own interest rates, and all interest rates are represented by my yield curve. And now I make myself the question, I ask myself the question, what happens if there is a shift? Now, if I consider the duration of the portfolio, by simply applying the definition of duration, it's minus 1 over P instead of S. S was the price of an asset. P is the value of the portfolio. It's minus 1 over P, delta Y, where delta Y is exactly this shift I am assuming or that I observe, okay? Now, what we know is that our portfolio is made of a certain number of assets, okay? And it's not difficult to see that if there is a variation in the total value of the portfolio, this variation can be disaggregated, can be split into the variations of the different assets composing the portfolio. I'm not saying that necessarily all assets need to change. For some assets, maybe the change is 0. But still, if I sum something plus 0, I can do that, and I can always write the change in the portfolio as the sum of the changes in the assets. So what I can do, I can apply the duration definition again, and what I have is that D is now equal to minus 1 over P, the sum of the sensitivities of the different assets with respect to the change in the yield. Okay, what I'm doing is just substituting delta P in this formula and collecting the terms. Okay, nothing more, nothing less. But now what is interesting here is that I can play a little bit with these quantities. I can collect these quantities as I prefer. And what I can immediately observe is that if I come back to the original definition of duration that we gave, if X is the value of the single asset instead of the S we were using before, if I consider minus 1 over Xi, which is asset I, times delta Xi, delta Y, this is the duration of the ith asset. But that means that if I take these inside and I rearrange these terms, I can say that the duration of my portfolio is nothing more than the weighted average of the durations of the assets. And what are the weights? The weights are nothing more than the importance of that asset over the total portfolio. So if I have a portfolio that is made by just 2 assets, and they have the same importance in my portfolio, so the total value of the portfolio is 100, and the 2 assets are 50-50, essentially they have the same importance, and that will be just the average of the 2 durations. But if I have an asset that accounts for 70% of the portfolio and an asset that is 30% of the portfolio, the total duration will be 70% the duration of the first plus 30% the duration of the second. If I have n assets, it will be n assets. So the duration of the portfolio is just the sum, the weighted, sorry, not the sum, is the weighted average of all the durations of the portfolio. You see, it's computationally nice because you have this linear relation between the duration of the single assets and the duration of the portfolio. So it's very simple if you have just parallel shifts to play with duration. Now, what can we say about hedging when we play with interest rates and with duration? We will see more when we introduce market risk property, not property, but also the properties of market risk, that interest rates are a tricky object and needs to be dealt with carefully. And on interest rate themselves, you could really not build one course, but a series of courses, because it's a rather complicated object. But you can imagine that if I build a portfolio and I intervene on the portfolio in a way such that duration is 0, essentially I'm building a portfolio that is immune to small changes in the interest rates, in the yields. And if I build a portfolio that also has a convexity equal to 0, it means that I will have a portfolio that is somehow immune over a short time horizon, because then there is dynamic hedging. So I will have to do that over and over again. It's not like the hedge and forget property of delta. So I will have to do that again. But if I make a portfolio that is duration and convexity equal to 0, my portfolio in a specific time horizon will be somehow immune to small and large shifts in the yields. Now the question is, if I want to make duration in a portfolio equal to 0 and I have a positive duration, it means that somehow I need to be able to generate a negative duration to compensate. If I have a quantity that is positive and I want to set it equal to 0, I need to remove something. So I need a negative duration. Now, negative duration is essentially something that we have already considered implicitly. As I was telling you before, in every transaction, there are 2 parts. If I buy a bond, there is someone getting the money and someone paying the money. I get the money because I'm buying the bonds and I get the money from the coupons and blah, blah, blah. But there is also someone that is paying the coupons, the issuer of the bond. If you are the issuer of a bond, you have a negative duration because you are not getting money, you are paying money. So for you, the transaction is negative. Your coupon here will not be 2.5, it would be minus 2.5 because you are paying. Okay? So duration will become a negative quantity. So essentially, when we speak about making a portfolio, building a portfolio with a duration equal to 0, we are not speaking about us. We are speaking, for example, about a large bank or a large company. You can do that by, for example, issuing a bond, going short on a bond, in a sense that you don't issue the bond, but still you go short on the bond, so you can build that, and this is something that we can also do ourselves. You can always go, if they trust you, short on an asset, and the duration strategy is nothing more than playing with the duration in a way in which your portfolio becomes decently robust to changes in the interest rates. Most of the time is just duration, No, you don't play with convexity, but there is no limit, so you can do whatever you want if you have the expertise and most of all the money and the trust to do what you want.